Traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. I'll just go through the key topics we'll look at in the next 30 minutes or so. So we'll just check out how markets are trading currently. We'll then, as we normally do, check out the main themes around the markets at the moment, and that is really all to do with tariffs. We'll then do a brief review of the latest inflation data, actually, which is of interest again to tariffs and the impact it might have going forward. We also had UK CPI data out today, so we'll look at that. We'll look at the cable chart as well. Before then, previewing quickly the central bank meetings this week, the Bank of Canada later today, in an hour or so, a couple of hours, and then the ECB meeting tomorrow. So we'll look at that and the dollar CAD and euro dollar. Firstly, just a couple of things about Errante and a couple of slides on this before then also having a look at the disclaimers. I need to do that before we just crack on with the main meat of the webinar. Here is the first disclaimer, just for you guys to briefly read through. Generally, the key objective of this webinar, as I've sort of said, is that we think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. So those are stories or narratives that can be, say, long-term fundamentals or short-term themes that increase or decrease in importance over time. And as I say, we tend to focus on a couple that we think are the key drivers of markets, and of course that is tariffs at the moment. So we'll just talk about a few thoughts we have around that as we see it. Okay, let's get into that then first of all. And firstly, we'll just bring up a chart of major FX performance in April, so month to date essentially, so just before Liberation Day, and we can just see evidently the dollar is struggling. The Swissy is absolutely rallying very strongly, and so are the other safe haven currencies. So the yen, of course, as well. The euro is doing very well as markets potentially move out of dollar assets, and the dollar and one of the biggest currencies, of course, which can handle that liquidity is the euro. So that has been doing very well. And then you get really then the commodity currencies and sterling, although sterling was doing reasonably poorly against his peers until this week, where it has picked up as we've had rumors of a sort of trade deal coming to pass very soon. JD Vance mentioning that, amongst other things. Just markets in general then at the moment. Well, the first two sessions of this week actually quite orderly, especially after last week's mayhem, of course. But then the news flow really over the last 24 hours or so has seen, well, risk face potentially a tougher rebound now going forward. Markets, interestingly, they seem to turn a blind eye really, but then Trump extended basically overnight the list of export controls to Nvidia's tailor-made H20 chips for China. Basically another escalation of the trade conflict between the US and China. We also had other worrying headlines about US probes into semiconductor, farmers, and possibly critical mineral imports, which are basically a prelude of more sectoral tariffs. We had China potentially ordering airlines not to take further deliveries of Boeing's jets, basically, and then we had rumors on pretty much little progress being made in talks between the EU and the US, as well as disappointing Q1 ASML earnings. All negative headlines, negative trade headlines as well. Potentially that could start to outweigh the reprieve coming from this 90-day pause we saw, of course, last week in reciprocal tariffs, and from also some product exemptions. Asian stock markets, they've struggled, down 1 to 2%. Lower European equities as well, down, and US futures as well, just checking down sort of 0.6% or so, spelling essentially more trouble ahead. Yeah, issues there, and just one major theme or a couple of themes then to highlight really. First of all, this chart, which is from Standard Chartered Investment Bank, courtesy of Bloomberg, a blog. Basically, markets generally, if we're just thinking sort of bigger picture, they have been maintaining a sort of nervous calm, in part because of the holiday week, of course, this week, but primarily there are two questions that must be answered before we can get through this period, really, and neither probably can be resolved anytime soon. The first is what kind of tariff regime may finally result. So this will largely determine a new global trading system. And of course, that system has already changed greatly since Trump 1.0, and the trade conflict really is China has attempted to diversify away from the US. But the extent of enduring new barriers to trade is still unknown. The second really concerns the risk that trust has been damaged, that foreign capital is staging potentially a disorderly exit from the US. I mentioned that at the top of the webinar, and trading in the last 6 months at least has been really a series of switches between these two narratives. And just looking at those briefly, then we've had this sort of talk about a Mar-a-Lago Accord idea, similar to the Plaza Accord of 1985. That idea is basically where the US can pull together a kind of grand deal in which everyone pays them some money and agrees to weaken the dollar in return for no tariffs and also security guarantees, if you like. Many minor elements of such an accord might still be reachable with individual countries, say, for example, but the message from US behavior of recent weeks really is that a true sort of accord to match that Plaza one of 1985 is basically out of the question. Nobody really now trust the US enough to do a deal. Whether they're too important to do a deal is then this other issue, because if we're getting capital flight out of the US assets and the dollar's going down, then that is an issue potentially. But it also leads into the other narrative, as I've just said, this exodus from the dollar. And on this theory, basically the US overplays its hand. That's what it's basically saying in both defense and foreign policy. And the rest of the world decides it's basically no longer to be trusted, and the huge sums of foreign capital in the US go home in a rush, and that all prompts a vicious circle. US stock market tumbles, treasury yields surge as the Trump administration basically belatedly realizes that it's been getting quite a good deal in the last few decades of being nice to its allies, and that is starting to change. Both scenarios essentially end with a weaker dollar, but the second has received a lot of attention of late because of treasury yields climbing while the dollar fell, and the rise in US asset valuations has left other countries, not just China, with massive holdings that they may want to repatriate. Okay, this chart, though, just to briefly touch upon, really shows us about this sort of possible loss of trust. It comes from the interaction of the dollar with bond yields, and usually exchange rates are driven in large part by interest rate differentials. So money flows to places where it will be paid higher rates, logically. But the chart basically shows the actual performance of the broad sort of Bloomberg dollar index. That's in blue. Contrast that then with the performance that could be predicted by rates, and you can just see generally it maps that, but this time around we've had this divergence in recent weeks, which suggests so bond yields racing higher, dollar going lower, and that really suggests this sudden shock to trust. Okay, just a couple of thoughts then on tariffs. Probably spent enough time around that now, but we also thought it was worth going into the US CPI data. Kind of looked through really last week because of all the turmoil in markets. But if we just move on to that now, so yeah, just a brief look at the inflation data last week from the US and that impact. Here's a chart really with what we got. Pleasant surprise, really, remarkably benign for March. This was, of course, headlines prices. They fell 0.1% month on month, and core, so that excludes volatile food and energy prices, rose just 0.1%. And in fact, if you look to 3 decimal places, it was 0.057, so pretty low. And the consensus, just for your guide, was plus 0.1 for the headline, plus 0.3 for the core. And even actually some feared a sort of 0.4, 0.5% print on the assumption that companies were looking basically to preemptively hike prices in then advance of the introduction of tariffs. So we didn't get that at all. Very pleasant surprise, as I say. The details, though, this is quite interesting for us going forward. So energy prices fell 2.4%. thanks to a 6% drop in gasoline prices. Airline prices fell after dropping in February as well. That kind of supports the story that we may see weaknesses in bookings in airlines going forward. Recreation prices, they fell, which is pretty unusual and suggests kind of discretionary spending is cooling. And also then potentially we see that in sort of leisure and entertainment venues. And then we had another drop in used car prices after basically big increases over the past 5 months. Ultimately, though, most economists think this won't be sustainable, though, given essentially 25% foreign auto tariffs, which potentially will deter potential buyers from purchasing a new car. Obviously, we've had news around potentially auto tariffs being lessened. But otherwise, it's that idea that consumers will hold on to their current vehicle for longer, limiting the supply of used vehicles. And then higher new vehicle prices will also inevitably mean higher repair and insurance costs. That will also show up in the CPI data. We'll also get tariffs and supply chain issues caused by tariffs. And of course, China's 125% tariff means US importers probably desperately now going to be looking at alternatives from other parts of the world, which will give those foreign companies greater pricing power and ultimately lead to higher prices from here. That is the kind of thinking many economists have around tariffs, essentially, that sort of logical thinking as well. But with the report, as I say, a pleasant surprise. On the face of it, gives the Fed room for maneuver if growth continues to soften. However, the Fed will be wary of course, tariff-induced price hikes and supply chain disruption that potentially some economists actually think inflation will get back to 4% in the second half of this year. Interest rate expectations for the Fed, just for your guide, they've been all over the place, really, of course, with market ructions. I think we had 107 basis points priced for 2025, only to drop to around 75 basis points on Trump's backtracking on some tariffs. Right now, I think we're now back to around 88 basis points or so somewhere between 3 and 4 cuts this year. And that is, of course, down to the deteriorating growth outlook and, of course, prospects of, well, inflation prints being higher near term, but softer further out. Okay, if we'll look at the dollar chart, actually. First up, which, if you just bear with me 1 second, is here. You can just see now we're just tracking this long-term low that we've got in here. This is the weekly chart. You can just see that long-term low from July 2023 at 99.57. We're just on that now, 99.60 we're trading. Really interesting, broke down through that sort of previous decent support from December 2023, which held prices in September of last year. That was at 160.61, and now we're just hovering on that key long-term support at 99.57. If we go back, we can see if we do lose this, then potentially, well, you've got the 100-month moving average. That's a 98.67, but there's not a lot of major levels in here. It's a bit messy. So, yeah, looking potentially dangerous if we can't hold this long-term support for the dollar. Just briefly, I said we'd mention UK CPI, a little bit softer sterling today after basically the headline dropped to 2.6%. And also the core dropped, but key as well was services inflation, and that dipped back to 4.7% in March. There is the worry, or certainly, if you just pull up a cable chart actually, but there is most economists thinking that headline will push back to around 4% by the end of the third quarter, all on higher energy prices. But really, the MPC will be looking at that services inflation gauge in April and May. Potentially that drops further, even though the Bank of England, have forecast a bounce back above 5%. Markets really cementing their views then of 3 Bank of England rate cuts this year, quarterly rate cuts essentially, with the next one pretty much fully priced in for May. For cable then, as I said, it had dipped recently and underperformed its peers, but now sort of found support around the halfway point of this September downturn, 127.66, just dipped below that for a couple of days, but then have bounced. Also the black line 200-day moving average and the 50-day moving average bounced off those quite nicely, really, 128.21 now and 127.09. They're now converging, interestingly, the 50-day potentially moving above the 200-day, which would be a bullish sign. We've had quite a few decent days, 1, 2, 3, 4, 5, 6, 7 straight days now of buying. Looks very strong for well, highs going back to, where are we now, October of last year, and potentially then that high from September of last year at 134.34. That will be the target for the bulls, certainly, but after 7 straight days, haven't seen that for a very long time, since August actually of last year. So potentially could get a pullback just on that. We're not overbought though, so 134.34 the target. Initial support maybe around 131.48. Okay, those are the last or review of the last week's main data, and of course that CPI data was out today. We just move on then to a preview then of this week's main events, and it is of course the ECB meeting and the Bank of Canada meeting. If we get to the ECB meeting first of all, we've just got a chart here with the inflation data, core, and the headline in red, core in the sort of blue color, and then we've got the benchmark rate and the target rate, of course. Inflation dipping down now slightly, so really expectations for Thursday are for the ECB to cut the depo rate by 25 basis points to 2.25%. Backdrop really dominated by Trump's tariffs, of course, and the trade agenda. Currently, he's announced, just for your guide, of course, a 90-day pause in tariff actions and cut reciprocals to 10% for nations that have asked for talks. Reports basically suggest, I think, kind of most recent now, the EU is considering pausing its countermeasures on the US. They were due April 15 actually yesterday, so they cancelled those for 90 days. Overall, though, the outlook for trade has improved over the past few sessions, certainly. However, it does remain very uncertain and continues really to suppress the growth outlook for the region. Accordingly, of course, then the Governing Council, the ECB, policymakers are set to take action by loosening monetary policy further. The statement really expected to basically reiterate the monetary policy is becoming meaningfully less restrictive, and then the Governing Council will follow basically a data-dependent and meeting-by-meeting approach. That's all expected. It kind of remains to be seen whether the bank will insert sort of any additional language or guidance due to the ongoing trade war. Probably unlikely, because there's so much uncertainty about that. Would be a surprise, so just keep your ears and eyes peeled for the headlines. There won't be any macro forecasts. It's not a quarterly, we don't get quarterly staff projections. And market pricing, well, it has been choppy, of course, given all the volatility in markets. I think the next 25 basis point cut pretty much priced in for July, and roughly 80 basis points of easing implied by year end. If we look at euro dollar now, if I just pull up the euro dollar chart, which we're getting a decent bid today. Interesting for the ECB then, they probably won't like the reality that the trade weighted euro is surging to multi-decade highs, but they potentially, or at least behind closed doors, they'll acknowledge its benefit and really the safe haven properties of the second most liquid currency in the world. That will also have some longer term benefits for Eurozone borrowing costs actually, and has already seen really actually the government, the German government bond, the 10-year bonds basically outperformed treasuries by 50 basis points, probably more now over the last 10 days, and that will give some comfort for borrowing costs going forward. It should be noted actually euro dollar at the moment trading way over any levels that sort of short-term interest rate differentials would suggest, and really it's just all about the dollar falling and the euro sort of gaining demand from people moving out of the dollar. Kind of don't want to stand in its way then at this point in time. We are overbought. We did ease that just with this pullback to that long-term support level, 112.74. That's 61.8 of the long-term decline actually from the high in 2021 down to this low in 2022. Yeah, I guess it's still valid. So yeah, 112.74, that support level. And then the recent highs at 114.73, with certainly the round number of 115 being a target for the bulls. If I just pull it back to the monthly, actually, you can just see this dotted line in here, which is the long-term downtrend line from the 08 highs. You can see that just tap these levels in 2021. We've just broken above it. You can see this month. So let's put it back to the weekly. You can just see a broke there. So that could be some support as well, which tallies with these highs from September of last year, just below 112, around 112. Okay, that is the ECB and euro dollar. If we look at dollar CAD now as well, and the daily chart, which is listed here. So the BoC, yes, a bit more of a close call, really. Yeah, just seeing the prior meeting basically, BoC cut rates to 2.75% by 25 basis points, basically. So it's 225 basis points now of easing that we've seen in this cycle. But Governor Macklem himself actually said now we're in the midpoint of the neutral rate estimates. That's at 2.25% to 3.25%. We're at 2.75%. The BoC, obviously, they dropped forward guidance earlier in the year, actually due to, of course, uncertainties ahead. Global risk off certainly has followed or has tempered the following the pause, and there is still uncertainty ahead, which could perhaps argue for a pause actually in the Bank of Canada neutral rate now, because we're basically at neutral. That is interesting. I think there's policy easing bets on this meeting really were above 65% or so only recently, but now they've come down to 40% or so now. So there's only basically a 40% chance of a rate cut, so a 60% chance that the Bank of Canada keep rates at 2.75%. So pretty much a knife edge coin toss, more or less, just below that, 60-40, 40-60, whatever. So will be interesting. Could see some volatility in the CAD, therefore, as markets so undecided. And I know analysts, economists are much more mixed as well. The latest labour market report, just for your guide, that was one of concern. But of course, we had inflation data out yesterday, which is, a downside surprise, basically, so softer than expected yesterday with the March inflation data. So, yeah, just a couple of economic points of note there. But of course, there will be all this focus around increasing trade barriers. At the moment, the USMCA, that was only subject to it was only subject to certain tariffs, but of course the economy is still subject to 25% tariffs in relation to the inflow of fentanyl into the US. There are tariffs on auto, steel, and aluminium as well. They still remain, but certainly the tariffs are only implemented generally on goods that are non-USMCA compliant. And potentially the 25% tariffs could drop to 12% if there were improvements, of course, as well in the flow of fentanyl. That 90-day pause, just for the guide, of course, for reciprocal tariffs doesn't apply to Canada because that wasn't subject to those reciprocal tariffs anyway. Apologies. Here is dollar CAD then that you can see. But yeah, just briefly on the Bank of Canada, sorry, then we do get actually The meeting is, accompanied by a monetary policy report that will incorporate the latest growth and inflation forecasts from the Bank of Canada. Good luck with those, of course, and its latest estimate of the output gap and neutral rate as well. So that will be of interest, and of course, then any guidance, any colour on what Governor Macklem and the Bank of Canada are thinking about, obviously, trade barriers. For dollar CAD, then that's been riding on the back of dollar weakness, of course, moving lower down to the 61.8 level of this big rally. That's a 139.44. We've got the black line, the 200-day moving average at 140, just as potential other more resistance as well. And then the recent low is at 138.27. And then below that, we've got a minor fib level around 137.15 or so. So that is dollar CAD. Expect some volatility because of this market's not entirely sure that we do get another hike, another cut, at this meeting. Okay, otherwise we do get, just bear with me. We do get US data as well, retail sales out later. That is, of course, the latest test of whether economic and tariff uncertainty is weighing on US consumer behavior, key component of the US economy, of course. It's really, yes, how much economic anxiety may be impacting consumer spending already. February saw only a marginal rebound as consumers curbed discretionary spending, while consumer confidence indicators have been battered, really. We also get a keynote speech from Fed Chair Powell on the economic outlook, especially the latter could hurt sentiment further, as basically Powell, well, it's whether he caves to market expectations of growth supporting rate cuts, or he sticks to the sort of, as well as supporting those rate cuts, yeah, he sticks to the anti-inflation line, similar to Fed's Waller, who did that recently, or he sticks to that sort of issue about worries about inflation over growth. Will be interesting, that speech that he gives, Fed Chair Powell, later today. Okay, hopefully that's given you guys some color on what's been happening around tariffs, of course, what will happen with those previews of the central bank meetings as well. Lots to consider, obviously, and potential volatility. And it'll be interesting, really, how markets respond, obviously building into or coming into the Easter break, and whether we get news over that, which would cause, extreme volatility going forward next week. Good luck with trading, of course. Just watch those headlines, and we will actually speak to you next week. So no break for us. So next Wednesday, we'll be speaking to you again with an update. Okay, take care.